Australia's quiet cost crisis, why retirees are paying for mining's blowouts. If you rely on dividends, pensions, or savings income, this matters more than any election or overseas conflict. Right now, Australian capital is being quietly redirected, not through taxes you can see, but through costs that never come back. Mining projects are overrunning, banks are tightening without saying it out loud, and retirees are left absorbing inflation that never quite disappears. This is not a future risk. This is already happening in balance sheets, dividends, and household budgets. The question isn't whether Australia is still wealthy. The question is who now carries the cost of staying that way. Stay with me. What is already breaking? Let's start with what has already shifted. Australia's economic engine has always been simple. Dig it up, ship it out, recycle the proceeds through wages, dividends, and government revenue. That model still exists, but the cost side has changed permanently. Major resource projects are no longer coming in on budget. Labor shortages, energy costs, logistics delays, and regulatory drag are not temporary inconveniences. They are baked in. When costs rise and output doesn't accelerate, margins compress. And when margins compress, something gives. It is not executive pay, it is not project ambition, it is cash return to shareholders and households. Mining companies are still operating, but they're absorbing more capital internally just to stand still. That changes the flow of money across the entire economy. This pressure feeds directly into the ASX, into bank lending behavior, and into the currency. Not tomorrow, now. Reserve Bank of Australia is watching inflation remain stubborn, not because demand is roaring, but because costs refuse to fall. That distinction matters. Who benefits quietly? Whenever costs rise, someone quietly benefits. In this cycle, it is not households. The quiet beneficiaries are commodity traders operating on volatility, exporters earning foreign currency while costs are local, institutions holding hard assets rather than income assets. Gold sits at historic highs for a reason. It is not optimism, it is protection. When project costs rise and currencies wobble, capital moves toward assets that do not depend on flawless execution. This is why defensive assets and offshore exposure are holding firm while domestic income assets feel strained. The benefit is not loud. It never is. It shows up as resilience, not excitement. Who pays the price? Now, let's name the zombie. The group paying the price is income-dependent Australian retirees holding domestic dividend assets. This is not an insult, it is a structural reality. Banks and miners are still profitable, but they are retaining more capital. Dividend growth is no longer guaranteed. Payouts are under pressure without anyone announcing a crisis. Households feel it through slower dividend increases, higher living costs, reduced purchasing power of the Australian dollar. The zombie does not collapse overnight. It fades. The danger is not loss. The danger is erosion. And erosion is hardest on those who planned for stability, not volatility. This is why relying exclusively on domestic yield has become riskier, even without a crash. What this means for the ASX and banks. The ASX 200 is not broken, but it is changing character. Banks are lending more cautiously, not because regulators are shouting, but because balance sheets demand it. Commonwealth Bank of Australia and its peers are prioritizing resilience over expansion. That means fewer aggressive loans, more conservative risk pricing, and less generosity with capital returns. This is prudent behavior. It is also a headwind for income investors. Mining giants like BHP continue to operate at scale, but project discipline now overrides growth enthusiasm. Again, sensible. Again, costly for retirees relying on cash flow. what this means for your capital. If you are retired or approaching retirement, this environment rewards three things. 1. Capital preservation. 2. Diversification beyond domestic income. 3. Assets that do not rely on cost perfection. This is not a call to abandon Australia. It is a call to stop assuming Australia alone can carry retirement income effortlessly. When costs rise, someone always pays. Right now, that someone is the quiet income holder. What comes next if nothing changes? If nothing changes, the pattern continues. Costs remain elevated. Dividends grow slowly, if at all. The currency absorbs pressure and households adjust downward. Quietly, no crash, no panic, just a gradual reset of expectations. Those who recognize it early adapt calmly. Those who don't feel blindsided later and wonder when it started, it already has. If this analysis resonated, watch our next briefing on why Australian retirees are quietly increasing offshore exposure without announcing it.